Longino. Today, we're going to speak about student loans with an emphasis in income driven repayment plans, loan forgiveness, loans in default. A lot of people are worried about what May 5th meant, what that deadline was all about. Excuse me, we'll get into the specifics. And also, some of the changes going on as the administrations change and new policies come into place. So there's been a lot of in the news about income-driven repayment plans. Um, what are income-driven repayment plans? Income-driven repayment plans are a set of repayment plans. The Department of Education has 70 different options for repayment. They're amongst those. They're based on what the IRS calls your discretionary income. They calculate this by taking what you make in a year, your adjusted gross income plus your family size, the difference between that and 150% of the poverty line. They divide it by 12. That's your discretionary income. The income driven repayment plans, as they stand today, and that may change in the future, are between 10 and 20% of that number. There are also qualified plans for the various forgiveness programs. You either have to make 120, 240, or 300 qualified payments. At the end of that repayment period, everything that's left is forgiven as long as you recertify that plan annually. Technically, income driven repayment plans, they're only for 12 months at a time. They have to be recertified every year. As long as you're in a qualified plan, you make your requisite number of payments, you have recertified that plan every year. At the end of that repayment period is where student loan forgiveness comes.
Erin, can my FIFA loan qualify for forgiveness if I consolidate them?
FIFA loans on their own, they don't qualify for very many forgiveness programs. A teacher loan forgiveness, they may still qualify for. They were supposed to originally, that's a different story for another day. They can be made to qualify. Consolidation is one way of doing it. Whomever asks to have your loans reviewed, we'll be able to be a lot more specific. There's sometimes, not even sometimes, there are different types of FIFA loans. But they have to be converted is the bottom line in order to qualify for forgiveness.
I'll take one more question. My loans have been in forbearance for a long time because I was in a financial hardship. Will those months count toward IDR forgiveness? I'm assuming this is not a PSLF question. Will those months count towards IDR forgiveness?
Usually, the answer is no. I say usually. There were temporary programs in 2021 and again in 2023 that ended June of 2024 that if you met certain qualifications, that time could be converted, but that is not how it normally works. Normally, no, you cannot. That time does not count towards forgiveness. Now, there are certain periods of forbearance and economic hardship deferments that can be bought back in the buyback program. Maybe that's where the question, what the questioner meant. You may be able to buy back that time, but on its own, no, that time doesn't count towards forgiveness.
Slide, last one. Do you have to be on an income-driven repayment plan to benefit from public service loan forgiveness?
Yes, it's a requirement of public service loan forgiveness. You have to make 120 qualified payments. A qualified payment is a full on-time payment while in an income-driven repayment plan, while in a qualified position. You absolutely have to be in one. So most borrowers, your average borrower, they assume that bill they get in the mail when their student loans first go into repayment, that's just the amount they have to pay. That's the student loan bill. And essentially, it is what it is, if you will forgive the expression. That isn't the case at all. As I mentioned earlier, there are 70 different options for repayment. If you look here, this is an average borrower. They make about $55,000 a year, family of five. with about $50,000 in student loan debt. That bill they received in the mail, that default payment is just a standard repayment or the default repayment plan when your loans go into repayment. That borrower would be expected to pay $530 a month. It doesn't change. It isn't based on your income or any other factors other than your student loan debt. Over the course of repayment, in this case, it's as if they repaid it in a 10-year time span. They would have paid about $63,639 because of interest over the $50,000 they borrowed. That same borrower, in this instance, qualifies for public service loan forgiveness. Under a qualified plan, they qualify for a $0 a month payment. When you're in a qualified plan, excuse me, the Department of Education, they'll estimate a 5% cost of living increase annually to calculate your first payment through your last. Although this isn't the 1960s, people don't really get a 5% raise annually. It's still a pretty good projection. Over the course of repayment, assuming they qualify for $0 a month payment every year upon recertification, this borrower would not have paid anything over the course of that repayment period. And that $63,639 that the previous borrower would have paid over the course of repayment under a qualified plan and public service loan forgiveness, that's the amount the Department of Education would expect to forgive federally tax-free.
I just graduated from college and I start my loan payments this fall. Am I going to make a standard repayment amount or an income-driven repayment amount?
As it stands, if you haven't done anything to your loans, you'll be making a standard repayment. It's the default repayment plan. It's likely they've already sent you information about this payment. I would have my loans reviewed. You may not want to be stuck in a standard repayment depending on what your goals are for your student loans. It is normally one of the three plans where you'll pay the most over the course of repayment.
Do the payments made on the SAVE plan count towards public service loan forgiveness once we begin our IDR? Will they convert over?
They're not going to convert over. If you're someone that's still in a SAVE plan, that plan needs to be changed immediately. It should have been changed last August. Nothing after July of 2024 is going to count for the SAVE plan. Not only that, borrowers have begun to receive letters from their servicers letting them know that while they're in a forbearance, interest will accrue. Initially, excuse me, under the previous administration, interest was not supposed to accrue while in the SAVE forbearance due to what's going on in the courts. But as administrations change, rules changed. And they announced that they were considering allowing interest to accrue and adding it retroactively for those on the SAVE forbearance. People began getting those letters last week. So not only do you need to change your plan because you're wasting qualified time, but now interest is going to be added. It appears as if retroactively for a year worth of forbearance time. That'll be a lot of interest.
How do I switch from a standard repayment plan to an IDR plan?
Have your loans reviewed. We'll take a look. We'll see exactly which plan works best for you. And you'll have the option after we've already given you the information, either do those things yourself or have us do it for you. So if you look here, this is the no, you're okay. This is the same borrower, all things being equal, except for this borrower in a qualified plan is not someone who qualifies for public service loan forgiveness. It's just student loan forgiveness. This borrower would pay about $118 a month. They would be expected by the end of their repayment period for their payments to have gone up to around $145 a month. At the end of their repayment period, over the course of repayment, they would have only paid $28,320, again, against the over $63,000 to the person in the default standard repayment. And at the end of this repayment, a 20-year repayment, which may go away depending on how the Senate votes. It may become 30 years before student loans are forgiven. But nonetheless, this borrower would have $35,318 forgiven, federally tax-free for now. Although Congress, it does seem as if Congress is going to let that expire at the end of the year. But as of right now, this would be federally tax-free forgiveness. That's the difference. Even for a 20-year repayment, this borrower paid for 10 years longer, and they still paid almost $30,000 less over the course of repayment than a default standard repayment. Half the time in repayment, they still paid almost $30,000 more, which is the difference between a standard default repayment and a qualified plan for a forgiveness program. Most borrowers, not all, most borrowers do themselves a disservice by not being in a qualified plan. If you're unsure what a qualified plan is, or if they'd even work for you, have your loans reviewed. We'll be more than happy to go over that with you.
Aaron, somebody wants to know if you or your team handles their loans. Do you reach out when they need to recertify?
So there are automatic communications to go out, but as the borrower, it's up to you to make sure you schedule an appointment so that we can do your recertifications. We're unable on our end to schedule an appointment for you. It's important that we communicate. The communications helps your advisor catch the mistakes that are made by either the Department of Education or your servicer. But also, things aren't uniform across borrowers. There may be something specific to your loans that need to be done that your advisor may not be aware of until they receive the letter that you receive, or any type of communication, or until we take a look at your loans. It's important that you meet with your advisor at least once a year for recertification purposes.
Okay, last question on this. I submitted an IDR plan in January to get off of SAVE, and my SAVE forbearance ends end of July. If my IDR plan is not processed by then, do I end up being on a standard plan until it's processed? They're great questions.
You're going to end up being in a standard repayment, but not for the reasons that you think. Firstly, if you did anything in January and it hasn't gone through yet, usually that would be an indicator that something has gone wrong. Something wasn't done correctly with the application. However, through a Freedom of Information Act, the Department of Education has been forced by the courts to submit progress reports, if you will. Come to find out, nothing from January to April was processed at all. So if you submitted anything in January, it's very likely it didn't go through, and it isn't going to go through. You need to do it again. Secondarily, since then, they've only processed, now it's up to 5% of their backlog, which means it isn't going to be looked at. You need to resubmit. So when we say loan forgiveness, what do we mean? I kind of touched on it before. You have to have federal loans. Obviously, there's no such thing as student loan forgiveness in the private student loan market. In that market, you're beholden to private banks. They're not going to forgive anything. You must have direct loans in addition to federal loans. FIFO loans won't get you there in virtually any scenario. Perkins loans won't get you there. Parent Plus loans won't get you there. On their own, these loan types won't get you there, but they can be made to qualify. They can be converted to direct loans. You have to make your requisite number of payments, whether it's 120, 240, or 300 qualified payments. If you're someone who qualifies for public service loan forgiveness, there's the added benefit that you work for a qualified employer directly, meaning they pay you directly. They'll say that you have to work full time, but it's really 30 hours a week on average. That 30 hours can even be cumulative between more than one employer. So as long as you work at least 30 hours a week on average, as long as you work for a qualified employer, those two are for public service loan forgiveness. For any forgiveness program, you have to make your requisite number of payments, whether it's 120, 240, or 300 direct loans in a federal student loan program. This is how student loan forgiveness works. I would add, as long as you recertify your plan annually, although that is encompassed in being in a qualified plan, and it's not a qualified plan if it's not recertified. But as long as those things, as long as that circle of bubbles are followed, at the end of your repayment period, everything that's left will be forgiven. It doesn't matter if it's $300, $300,000, or $3 million. It will be forgiven at the end of your repayment period. So, anyone has ever spoken to me or seen one of our webinars, they'll know I am not a fan of the servicers. In my opinion, the servicers do what's in their best interest as opposed to the borrowers. When I say servicers, what I mean are your Mohilas, your Nailnets, your Navians, your Ed Financials, those in which you make your payments to. Mohila has even said in open court, so this part isn't an opinion, that student loan forgiveness is not in their best interest. They lose money when loans are forgiven, and they aren't in the business of losing money from their perspective. 98% of people that actually qualify for these programs, they never get it. Usually it's some miscommunication between the borrower and their servicer. I don't think the slide is up anymore.
Sorry, hold on.
As I was saying, usually there's miscommunication between the borrowers and the servicers. Miscommunication is me being generous today. But there's also changes in administrations and political philosophies. One administration has a different focus than another. There may be loan program discrepancies, or you as the borrower may qualify, but your loans may not. If you're in doubt about a forgiveness program or whether or not you qualify for one at all, have your loans reviewed. We'll be happy to point you in the right direction, or at least explain to you what you do and do not qualify for.
All right, Aaron, I have two questions about loan servicers. I was told by my servicer I didn't need to recertify my employment annually, but now my PSFL application is being denied. Can I appeal? Oh, wait, there's two back to back. The other one is, I think I made 120 payments, but my servicer said I only have a 90 count due to my loan type. How can that be?
It sounds as if, I'll take the second question first. It sounds as if you may have used a temporary program, be it the account adjustment or the public service loan forgiveness waiver, which converted non qualified time into qualified time. But since your loans were never properly enrolled into public service loan forgiveness, you never got any new qualified time after you converted some non qualified time into qualified time. You'll never get any more qualified time without your loans being properly enrolled into the program. The first question, I have to be frank, I'm not surprised. The servicers told millions of people not to recertify. When it comes to the federal servicers, I would never tell anyone not to communicate with their servicer. Our tax dollars literally pay them tens of millions of dollars a month to service our student loans. Trust but verify when you speak with your servicer. You almost need to already know the answer to the question when you speak to them. Income-driven repayment plans must be recertified every 12 months. If they're not, you're not getting any qualified time. For example, the 8 million borrowers that are on a SAVE plan, they all got letters saying their recertification is sometime in 2026, far past 12 months. They got these letters, some in January, some last fall. That's because they're not making qualified payments. There's no qualified time being had. Otherwise, they would have to recertify every 12 months, or they're no longer in an income-driven repayment plan. Technically, they have a standard repayment price, which in most cases is not a qualified plan. Have your loans reviewed. We'll be very specific about what it is you need to do, but any and everyone in the SAVE plan needs to be out of it. Any and everyone in a qualified or income-driven repayment plan needs to have that plan recertified every year. Possibly, and I would need to review these loans to speak with more confidence, possibly through a temporary extended public service loan forgiveness application, which we'll speak about later. You may be able to get some of that time, but we would need to look at them and see.
I have 18 payments left before I receive loan forgiveness. If I make those payments early, will my loans be forgiven early?
Yes, but you can't make all 18 payments early. Since income-driven repayment plans are for 12 months at a time, and because you're able to prepay but not overpay, you can make up to 12 payments um, in advance. You can prepay for 12 months, but not beyond. So you have to get through those last 6 before you're able to make the next 12. But then you are able to apply for forgiveness once you've made your 120th qualified payment. So I touched on this a bit, but I'm going to try to bring it all together and make it a little more cohesive. So the SAVE plan was an attempt by the last administration to make student loan payments more affordable. It recalculated what discretionary income was, which, as I explained earlier, is how they calculate your monthly payment. What the courts have said through a lawsuit brought on Mohila's behalf was that the Department of Education under any administration cannot unilaterally supersede the will of Congress. They can't change what Congress set in place. Congress passed student loan forgiveness back in 1994, and it had a specific rule set and how payments will be calculated. The court said no administration or no Department of Education can change those. It has to go through Congress. So the SAVE plan was not only deemed not a qualified plan, but not a plan at all. They cannot calculate a payment under SAVE. They cannot process a payment under SAVE. Even if you send in a payment, they'll hold that payment until you're no longer in a SAVE plan. They'll apply it there. It appears as if they're not processing buyback applications for time under SAVE. That doesn't mean the time before that plan became SAVE, but while it was SAVE. All 8 million borrowers on the SAVE plan are in a forbearance. This forbearance will not count towards public service loan forgiveness. It will not count towards student loan forgiveness. Interest, it appears as if, will be added retroactively. If you're in the SAVE plan, whether you move yourself or get with the assistance of a professional, have it moved, you need to be out of the SAVE plan if affordable, so that you can continue to make qualified payments and be on track to having your loans forgiven completely. So there was a lot of news surrounding May 5th, May 5th, May 5th. What's going on with May 5th? So, as all of you, I'm sure, remember, student loans were not in repayment for 3.5 years because of COVID-19 originally. There was an off-ramp period when loans went back into repayment where they were not reporting delinquencies. That off-ramp period has ended, and beginning May 5th, loans will return to the status of default, and they will return to being garnished, to garnishment. When we say default, what does that mean? It means you have defaulted or broken the agreement in which you agreed to repay your student loans. Your loans are no longer with the Department of Education, they're with a collection company. You're being charged 24% interest, 18% compounded daily. You've lost all your federal privileges, meaning you're not able to get any more student loans. Meaning, if you're someone who receives an income tax return, that income tax return will be taken, or offset is the word, excuse me, they like to use. It'll be taken. They usually will only apply between $5 and $50 to the interest of your student loans. The rest, the collection company who now has your loans will keep. That isn't the worst case scenario. Worst case scenario is what happens next. The final stage of default is garnishment. There's an actual judgment against you in a court of law. They'll take 15% of every taxable income you receive, whether it's employment, unemployment, Social Security, some investment income. If it's taxable, they'll take 15% of it before it's even taxed. Before you even see your money, they would have already taken 15% for the foreseeable future. A lawyer would typically charge between $3,000 and $5,000. Here in Ohio, I can only imagine what are some of the bigger markets they charge. We are able to get you out of garnishment. It is difficult and expensive. We're not nearly as expensive as a lawyer would be. But even us would prefer to do it before it got to that point. We are able to help with garnishments and default. If you think your loans are in default or you may be garnished, have them reviewed immediately. You don't want to deal with that. Ways that you are able to get out of default, the collection company will only tell you about a rehabilitation program. That's where you negotiate a fair and reasonable monthly payment where you pay 9 months, 9 consecutive months, and your loans will come out of default. The problem is you're dealing with a collection company. Until after the 5th month, they're still able to resell that debt, and most often than not, they do. You'll make your first payment, your second payment, your third payment. You'll go to make your 4th, 5th, or 6th, and that collection company will no longer have your loans. So not only do you have to find where they are, wait on hold to speak with someone, get to the right department, but you then have to begin your rehabilitation program anew. Now, you don't always need a rehabilitation program. Sometimes there are simpler ways. Have your loans reviewed. We'll be very thorough in the review and tell you whether or not a rehabilitation program is needed.
All right, I'm going to jump into a question. Is it recommended to submit IDR plans and or loan forgiveness applications to the servicer directly or on the FSA website?
Your tax dollars fund the servicers. The servicers are state institutions. That's who you make your monthly payments to. They're the people that are supposed to help you with your student loans. I wouldn't tell you whom to speak with. Your tax dollars fund the whole system. If there's an easier time with your service or the Department of Education, they'll equally mess up anything you give them. You kind of have to know what it is that you're trying to do if you're going to speak with them. Have your loans reviewed, at least have a strategy as to what to say. But I wouldn't tell you not to speak to one over the other. So 98% of people that qualify for especially public service loan forgiveness, they do not get it. I would say virtually none of them know about a temporary extended public service loan forgiveness application. What that is you saying to the federal government, essentially, I wouldn't word it like this, and I'm sure you wouldn't either. But your servicer has done you a disservice. Not only did they not tell you the correct plans and programs you needed to be in for public service loan forgiveness, they didn't tell you that you even qualified for the program or that this program even existed. They know what you do for a living. They verify your income with the IRS. This is you saying to the Department of Education, look, the plan I was under, I paid equal to or more than I would have paid under a qualified plan, and I'm asking for this time to be converted into qualified time, like it would have been had I known about these programs. They can say yes or they can say no. Now, there is criteria for temporary extended public service loan forgiveness time. So you'll at least know if you qualify for it. You have to already be at the point where if you had this time, that's all the time you needed under public service loan forgiveness, and your loans will be ready to be forgiven. There's finite amount of funding for temporary extended public service loan forgiveness applications. They look at them only when there's funding for them, which there is surprisingly right now. If you think you should have had your loans forgiven, a person that says they only have 90 qualified payments, and they believe they should have been at 120, that person comes to mind, is very likely the rest of that time can be found under a temporary extended public service loan forgiveness application. So last year, before the changing of administrations, I actually think it was announced in 2023. Um, a program was announced called the buyback program. You can buy back time that normally should not be eligible as long as that time was under direct loans. Um, they'll calculate what your payments would have been. For instance, if you were in forbearance or economic hardship deferment, the second part of that question comes to mind. They'll calculate a monthly payment. Let's say that you are, I think that person had 108 payments under public service loan forgiveness, but they had time under economic hardship deferment because times are hard. Your servicer can calculate those months you were under that forbearance or economic hardship deferment, tell you how much the payments would have been, and you're able to make that payment and get that time converted from ineligible to qualified time. And it's in some cases is all the time people need. Now, under that Freedom of Information Act that we just discussed before, a list was published about all the time that's supposed to be eligible for buyback. Included in that time is time under the SAVE forbearance. However, directives come from the top at governmental agencies, and I'm going to make an attempt to be as apolitical as possible. When the administration's first changed, there was a memo sent to the Department of Education saying not to process any forgiveness for income-driven repayment plans, not to enroll income-driven repayment plans, and not to process any buybacks for the SAVE plan. The first two instances have been rectified already. It appears as if they are still not looking at buyback applications for anyone under the SAVE plan. If I were a borrower and had buyback time, I would change my plan first and then apply for buyback. If you're someone like your average borrower who has no idea what any of this means, have your loans reviewed. It'll be a lot easier to understand when it's more personal, when it's about your loans, the periods of time that you may have been under an economic hardship for deferment or forbearance, and how to buy that time back. So what is it that we do? If you haven't caught on by now, we review student loans. The first thing we want to do is to review your loans. We want to see how many you have, how much they are, who holds them, and the status that they're in now and throughout repayment. Without doing these things, we're really just speculating at what you may or may not qualify for, which we don't like to do. Once we review your loans, we'll make a suggestion as to what we think you should do. We'll run a projection based on that suggestion. We'll tell you exactly how much you could be paying versus what you're paying now, how much longer you should have in repayment versus your current repayment period, and how much of any and when the Department of Education would expect to forgive those loans. At that point, you're free to take the information that we've already given you and do those things yourself, or you can hire us to do them for you. For that part, we have a fee. We'll be very upfront about what it is, depending on what needs to be done. You'll have the option of just having us enroll you into the plans and programs that we discussed, or you will have us for continued service, meaning we'll recertify your plan every year, your public service loan forgiveness every year. If something happens like going on right now with the SAVE plan, we'll switch that plan for you to a plan that works best for you. For example, there's a doctor that works here in Cleveland at University Hospital. She was enrolled in a public service loan forgiveness, but during the changing of administrations, when plans were temporarily taken down, she no longer qualified for any of the plans. As I was going through another client's loan during the time when the courts made the Department of Education's reinstate those plans, it made me think about hers. So I actually contacted this doctor, had her schedule an appointment so that I could take another look at her loans. And although those plans may be going away depending on what happens in the Senate, we can at least recoup. We found out about 13 months worth of qualified time before that even passes the Senate. So if it does come back in the future, she'll have all the qualified time that she needs, and her loans may be forgivable before then. So that's what it is we're able to do. But at the very least, we'll review your loans and make sure you're in the right plans or programs.